Welcome to our January 2023 market overview. In this presentation, we're going to review the performance of investment markets in 2022 and look ahead at what may impact markets in the new year. Last year was a painful year for most investors, as almost all major asset classes, with the exception of commodities, were down double digits for the year. Investment grade bonds lost 13%, international stocks were down 14%, and US stocks were down over 18%. Commodities were the lone exception, posting positive returns primarily as a result of higher energy prices during the first half of the year. The story of 2022 was of inflation and the Fed's response to higher inflation. Over the course of the year, inflation measures such as CPI hit levels that we haven't seen in over 40 years. That higher inflation, and particularly the persistence of higher inflation over a longer period than initially forecast, caused the Fed to take aggressive action. Beginning in March, the Fed used their primary lever, the Fed funds target rate, to implement a restrictive monetary policy designed to curb higher inflation. The target rate went from 0% to 4.25% in less than 1 year. While the current level of interest rates is not high relative to history, the rapid increase in rates during such a short time period had a negative impact on most asset prices. Bonds, typically a safe haven during periods of equity market volatility, had one of their worst years on record. The Bloomberg Aggregate Bond Index declined by 13% during the year. The best performing sector of the fixed income market, municipal bonds, declined by 8.5%. And even TIPS, which are designed to provide inflation protection, lost almost 12% because of their interest rate sensitivity. US stocks also declined in response to the Fed's actions. The S&P 500 index was down almost 20% for the year. On a sector basis, energy was the only bright spot, posting higher returns due to higher oil prices. The communications and consumer discretionary sectors were the worst performing, declining about 40% during the year. To better understand last year's returns, it is key to understand the drivers of stock market performance. Two fundamental factors drive stock market returns: earnings and valuations. Earnings continue to be strong, with S&P 500 companies posting all-time highs for earnings per share. And while earnings growth rates have declined, we still see positive earnings growth near historical averages. It's safe to assume earnings weren't the driver of the negative returns. The other factor, valuations, drove most of the negative returns in 2022. Valuation is basically how expensive a stock is relative to its underlying financials. While there are different measures of valuation, such as price to earnings or price to cash flow, the price to earnings data shows the problem with stocks. Valuations increased throughout the pandemic, driving stock returns higher than the underlying earnings growth. In 2022, that trend reversed, and while earnings remained strong, valuation multiples contracted. To understand how changing multiples impact stock returns, let's imagine a hypothetical stock. Assume it earns $1 per share and is trading at a multiple of 25 times earnings. Its stock price would be $25 per share. Assume earnings grow 20% to $1.20 per share. Maintaining the same 25 times earnings multiple, the stock would increase to $30 per share. Now let's assume that the multiple contracts. Instead of trading at 25 times earnings, the stock trades at 20 times earnings. Assuming the same 20% earnings growth, the stock with earnings of $1.20 would trade at $24 per share. Fundamentally, most investors would be excited to own a company that grew earnings 20%. But if the valuation multiple compresses, they may lose money. This happened across a wide swath of stocks in 2022. This phenomenon of changing valuations is ever so visible in the performance of the FANG stocks. Meta, formerly Facebook, Amazon, Apple, Netflix, and Alphabet were some of the largest technology stocks and best performers recently. While their earnings grew rapidly during the pandemic, their valuations grew at an even faster rate. In 2022, that trend reversed itself, and those companies came crashing back to earth. Similar to the US, international stocks also faced a difficult 2022, with the added volatility of large currency price movements swinging returns for US based investors in international stocks. The US dollar had a strong rally relative to other major currencies through the first 3 quarters of the year, causing international to underperform the US. That rally eased and the dollar gave back much of its gains in the fourth quarter, driving strong returns for international stocks as we closed out the year. As we look ahead to 2023, it's important to understand the current economic environment and the outlook for the US economy in the year ahead. Throughout much of last year, the conventional wisdom was that the Fed's aggressive move to snuff out inflation was likely going to result in a recession. This was reinforced by slight declines in US GDP growth during the first half of the year. Third quarter, we saw a bounce back with 3.2% annualized GDP growth, and the recently announced fourth quarter GDP number at 2.9% showed continued economic growth through the end of the year. Aside from continuing growth in the US economy as measured by GDP, other fundamentals of the economy are also showing resiliency in the face of higher inflation and rising interest rates. Unemployment continues to hover near record lows. Labor market tightness does not just show up in the unemployment rate. There continues to be millions more job openings than applicants, and initial jobless claims remain muted. While I know that some of the large technology companies have been making headlines with large-scale layoffs in January, it's important to understand that headlines don't always tell the full story. Tightness in the overall labor market is translating into higher wages for workers. These higher wages are providing some offset to workers for the effects of higher inflation and allowing consumer spending broadly to remain more resilient than many would expect. Additionally, the significant growth in household net worths over the past decade is providing a buffer to consumers in the face of higher prices, providing support for the overall economy even as interest rates continue to rise. Without a doubt, 2022 was painful. For most investors, the tried and true strategy of diversification provided little benefit as they experienced double-digit losses in both their stocks and bonds for the first time in their investing lives. While painful, it is important to keep in mind the longer-term perspective. Over the past 4 years, the market is up 53%. And since the peak before COVID, the market is still up over 13%. What is challenging for most is the path we took to get here. In the midst of the worst of COVID, the market rallied, posting gains that were unexpected to most investors. And as it seemed we were starting to return to our new normal this past year, stocks fell back to earth. For me, continues to reinforce the belief in long-term investing as the only solution to deal with the risks we face as investors. We know the market goes down, but for those with the patience to stay invested, we also see the recovery happen much sooner than most would realize. Thank you for viewing our January 2023 market update. If you have any questions or if we can be of any assistance, please do not hesitate to reach out to us.